In 1913, the average American paid $0 in federal income tax. Today, the IRS collects over $2 trillion annually. But here's what they don't teach you in school. For the first 137 years of American history, there was no permanent income tax at all. So what changed? And, more importantly, why did a nation literally founded on tax rebellion become one of the most heavily taxed societies in the developed world? The answer isn't what you think. This is the true story of American taxes, from revolution to the reforms of 2026. December 16th, 1773. Boston Harbor. A group of colonists, disguised as Mohawk Indians, boarded 3 British ships and dumped 342 chests of tea into the freezing water. The Boston Tea Party wasn't about tea, it was about taxes. Specifically, it was about taxation without representation, the idea that the British Crown could levy taxes on colonists who had no voice in Parliament. But here's the irony. The actual tax rate the colonists were protesting? About 1 to 2%. Compare that to today's federal income tax rates, which range from 10% to 37%, and you start to see just how far we've come. When the Founding Fathers drafted the Constitution in 1787, they were deeply suspicious of direct taxation. Article 1, Section 9 explicitly stated that no direct tax could be levied unless it was apportioned among the states according to population. Translation: the federal government could impose tariffs and excise taxes, but it couldn't tax your income directly. For over a century, this system worked. The federal government funded itself primarily through tariffs on imported goods and excise taxes on specific products like whiskey and tobacco. In 1794, when Alexander Hamilton imposed a tax on whiskey, Western Pennsylvania farmers literally took up arms in what became known as the Whiskey Rebellion. President Washington himself led 13,000 troops to put it down. The message was clear: Americans did not like being taxed. Then came 1861. The Civil War. Wars are expensive. The Union needed money, lots of it. Tariffs alone couldn't fund the massive armies, weapons, and supplies required to fight the Confederacy. So in 1861, Congress passed the Revenue Act, which imposed a 3% tax on incomes over $800. This was America's first income tax. But it was sold as temporary, a wartime emergency measure. And it was. By 1872, the income tax was repealed. For the next 41 years, America once again had no federal income tax. But something had changed. The precedent had been set. The government now knew it could tax income in times of crisis. Meanwhile, America was transforming. The Gilded Age brought unprecedented wealth, but also unprecedented inequality. Industrialists like Rockefeller, Carnegie, and Vanderbilt amassed fortunes that dwarfed anything seen before. By the early 1900s, public sentiment was shifting. Progressives argued that the wealthy should pay their fair share. And tariffs, which fell disproportionately on working-class consumers, were seen as regressive. The stage was set for a permanent income tax. February 3rd, 1913. The 16th Amendment to the Constitution was ratified. It reads, "The Congress shall have power to lay and collect taxes on incomes, from whatever source derived, without apportionment among the several states." With just 30 words, the entire foundation of American taxation was rewritten. The first permanent income tax was modest. A 1% tax on incomes over $3,000, about $92,000 in today's money. Only the wealthiest 3% of Americans paid anything at all. But World War I changed everything. By 1918, the top marginal tax rate had skyrocketed to 77%. Suddenly, the income tax was no longer a tax on the rich. It was becoming a mass tax. After the war, rates came down somewhat, but they never returned to pre-war levels. The 1920s saw top rates around 25%. Then came the Great Depression. And World War II. By 1944, the top marginal rate hit an astonishing 94%. 94%. And for the first time, the income tax became a middle-class tax. Withholding was introduced in 1943. Your employer would deduct taxes from your paycheck before you even saw the money. This wasn't just convenient, it was strategic. Studies show people feel less pain when taxes are automatically withheld than when they have to write a check. The income tax had become invisible and permanent. After World War II, tax rates remained high by historical standards. Throughout the 1950s and 60s, the top marginal rate hovered around 90%. But here's the secret: almost no one actually paid that. The tax code was riddled with deductions, loopholes, and exemptions. Wealthy individuals and corporations employed armies of accountants and lawyers to minimize their tax bills legally. In 1981, President Reagan slashed the top rate from 70% to 50%. By 1986, it was down to 28%. The argument was simple: lower rates, fewer loopholes, and economic growth would generate more revenue overall. Did it work? That depends on who you ask. Revenue did increase in absolute terms. But as a percentage of GDP, federal tax revenue remained relatively stable at around 17 to 19%. Meanwhile, the tax code grew more complex. By the early 2000s, the Internal Revenue Code exceeded 70,000 pages. The average American spent 13 hours preparing their tax return. And the gap between what was owed and what was actually collected, the tax gap, reached nearly $600 billion annually. Then came 2017. The Tax Cuts and Jobs Act slashed corporate tax rates from 35% to 21% and reduced individual rates across the board. Supporters argued it would supercharge the economy. Critics said it would explode the deficit. Both were partially right. Economic growth accelerated in 2018, but the federal deficit ballooned to over $1 trillion. Which brings us to 2026. Many provisions of the 2017 tax cuts are set to expire this year. Congress faces a choice: extend them, let them expire, or craft something new. But the debate isn't just about rates anymore. It's about fairness. A 2021 ProPublica investigation revealed that some of America's wealthiest individuals, including Jeff Bezos and Elon Musk, paid little to no federal income tax in certain years. How? They didn't sell their assets. They borrowed against them. And borrowed money isn't taxable income. This has sparked calls for a wealth tax, a minimum billionaire tax, or reforms to capital gains taxation. At the same time, there's growing interest in simplifying the tax code entirely. Some propose a flat tax. Others advocate for a value-added tax, like most developed nations have. The truth is, we're at a crossroads. The system we have today, built over more than a century of wars, depressions, and political compromises, no longer reflects the economy we live in. So here's what we know. America was founded on tax rebellion. For 137 years, there was no federal income tax. When it was finally introduced in 1913, it affected only the wealthiest 3%. Today, nearly every working American pays it. We've gone from a top rate of 1% to 94% and back down to 37%. From a simple one-page form to a tax code that fills thousands of pages. And yet, the fundamental questions remain the same. Who should pay? How much? And for what? The 2026 reforms, whatever they turn out to be, won't end this debate. Because at its core, taxation isn't just about revenue. It's about values. It's about what kind of society we want to build. And it's about who gets to decide. The founders fought a revolution over a 2% tax. Today, we accept rates many times higher. Not because we love taxes, but because we've come to accept them as the price of civilization. Whether that price is fair, efficient, or sustainable, well, that's a question every generation has to answer for itself.